When selecting funds for your portfolio, it's not enough to just diversify based on the type of scheme or the fund house or fund manager. You must consider the investment strategy, which includes their style of fund management. Basically, different investing styles perform in different parts of the market cycle. And so it works to your advantage to have invested in different styles of management so that a part of your portfolio is always performing, irrespective of how the external environment is doing. So here's a quick refresher on how these three styles, value, growth, and blend, work. So value investing primarily means buying a stock which is available cheaper than its intrinsic value. Value stocks will display some or all of these characteristics: low price to earnings, low price to book, both either on an absolute basis or relative to peers. They'll also offer higher dividend yield and would be under-owned. So if you've ever bought winter clothing in the summer when it's cheaper, you'll understand this basic premise, right? Which is why it's also referred to as contrarian or counter-cyclical investing. On the other hand, growth investing means buying those stocks which are showing higher earnings growth even if they are expensive. It's kind of like buying the runway styles of a high fashion brand, right? The characteristics which growth investors look for in stocks are higher sales growth, cash flow growth, higher price to earnings, price to book, and lower dividend yield. Remember, it's the consistency of growth which is important here. And blend lies somewhere in between. Buying growth but at a reasonable price. A sensible shopper with an eye for the good stuff. The focus is on stocks that can grow consistently at higher than average growth rates, but the valuation is relatively cheap. Managers could look to exit or even trim positions if valuations become excessive. But each of these styles have their risks too. Value investing requires patience. The investor must steer clear of value traps as well. With growth, the risk could be paying too much and dealing with a crowded space, too many buyers chasing the same stocks. For the blend style, stocks meeting the investment criteria could be limited, especially in sustained bull markets, and of course, the risk of selling too early. So now that you know what each of these investment styles are, how do you know which one is your mutual fund scheme following? Well, it's simple. You can just check the style box available on various informational websites to know the style. And remember to invest in funds with different styles to maximize the benefits of diversification in your portfolio. Also remember not to exit underperforming funds in a hurry. Funds following a particular style will underperform when the market cycle is not in their favor. Happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.